Hello, everyone, and welcome back to the Everyday English Bite. Over the last few episodes, we've talked about saving money in banks and protecting it with insurance. But if you truly want to grow your wealth and beat inflation, saving is usually not enough. You have to invest, and the most famous place to do that is the stock market. Today, we're taking a trip to Wall Street. We will explore exactly what a stock is, the different types of U.S. stock markets, and what happens after the official market closes. We will also learn the essential trading vocabulary you need to navigate this exciting world. Let's get started with our key vocabulary. Here are 3 essential words you need to understand the stock market. 1. Shareholder. A shareholder is a person, company, or institution that owns at least one share of a company's stock. Because they own a share, they are partial owners of the company. Example 1. The company's CEO must answer to the shareholders at the annual meeting. Example 2. As a shareholder, you have the right to vote on major company decisions. 2. Dividend. A dividend is a portion of a company's profit that is paid out to its shareholders. It is a reward for trusting the company and holding its stock. Example 1. Many retired people invest in traditional companies because they pay a high, reliable dividend every quarter. Example 2. Instead of taking the cash, I automatically reinvest my dividend to buy more stock. 3. Volatility. Volatility measures how much the price of a stock goes up and down over a short period. High volatility means the price changes rapidly and dramatically. Low volatility means the price is stable. Example 1. Cryptocurrency is known for its extreme volatility compared to traditional stocks. Example 2. If you can't handle market volatility, you shouldn't check your investment app every day. Great! Now let's demystify the U.S. stock market. Inside the U.S. stock market, what exactly are you buying when you buy a stock? Imagine you want to start a massive coffee company, but you need $1 billion. You don't have that money, and no single bank will lend it to you. So you divide your company into millions of tiny pieces called shares and sell them to the public. When you buy a stock, you are buying a tiny percentage of that company. You are not just a customer, you are an owner. Owning a stock means 2 important things. First, if the company grows and becomes more valuable, the price of your tiny piece also goes up. You can sell it later for a profit. Second, as we learned in our vocabulary, healthy companies often share their actual cash profits with you in the form of dividends. You are risking your money to help the company grow, and in return, you share in its success. In the United States, you don't just buy a stock from a random store. You buy it on a massive financial exchange. There are 2 giants you must know. The first is the NYSE, the New York Stock Exchange. This is the oldest, most traditional stock market in the world, located on Wall Street. When you see pictures of traders shouting on a busy floor, that is usually the NYSE. It is home to massive, historic companies like Coca-Cola, Walmart, and Disney. The second is the NASDAQ. Unlike the NYSE, the NASDAQ doesn't have a traditional physical trading floor. It was the world's first fully electronic stock market. Because of its modern, digital nature, it attracted almost all the major tech companies. Apple, Microsoft, Google, and Amazon are all traded on the NASDAQ. Let's look at the clock. The U.S. stock market operates on a strict schedule. Regular trading hours are from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. During these hours, buyers and sellers negotiate prices. The price a buyer is willing to pay is called the bid, and the price a seller wants is called the ask. When those 2 numbers match, a trade happens. But what happens at 4 p.m.? The closing bell rings, but trading doesn't entirely stop. This brings us to the aftermarket, or after hours. With modern electronic systems, investors can continue to buy and sell stocks from 4 p.m. to 8 p.m. Eastern Time. Why is this important? Because many companies release their quarterly earnings reports, telling the world how much money they made exactly after the regular market closes at 4 p.m. If a company announces terrible news at 4:05 p.m., investors in the aftermarket will panic and start selling. By the time the regular market opens the next morning, the stock price might have already crashed. The aftermarket is very exciting, but because there are fewer people trading, the volatility is incredibly high. It is much riskier than regular trading. Finally, you will hear two animals mentioned constantly in the stock market: bulls and bears. A bull market means the economy is great, people are confident, and stock prices are generally going up. Think of a bull attacking by thrusting its horns upward. A bear market is the opposite. It means the economy is struggling, people are scared, and stock prices are falling. Think of a bear attacking by swiping its heavy paws downward. Understanding the overall mood of the market is just as important as understanding a single company. Today's English idioms. We learned a lot of financial terminology today. Let's wrap up with 3 common English idioms that are heavily used in the world of investing and business. I will explain the meaning and the context together, followed by 2 examples. 1. Put all your eggs in one basket. Meaning and context. Imagine carrying all your eggs in one single basket. If you drop it, everything breaks. In investing and daily life, this idiom means risking all your money, effort, or resources on just one single plan or one single company. Financial advisors always use this phrase to warn people to diversify their investments. Example 1. It's dangerous to buy only tech stocks. You shouldn't put all your eggs in one basket. Example 2. I'm applying to several different universities because I don't want to put all my eggs in one basket. 2. Take a nosedive. Meaning and context. A nosedive is what happens when an airplane's nose points straight down towards the ground and it falls rapidly and severely. We use this idiom to describe a situation where a stock price, a company's profits, or even someone's reputation drops incredibly fast and severely. Example 1. After the CEO was arrested, the company's stock price took a nosedive. Example 2. My grades took a nosedive this semester because I spent too much time playing video games. 3. Blue chip. This term actually comes from the game of poker, where the blue chips are traditionally the most valuable chips on the table. In the stock market, a blue chip company refers to a massive, nationally recognized, well-established, and financially sound company. They are considered very safe investments that can survive bear markets. Example 1. During the economic crisis, investors moved their money out of risky startups and into safe blue-chip stocks. Example 2. Samsung Electronics is considered one of the most reliable blue-chip companies in South Korea. And that is our bite for today. You now know what it means to be a shareholder, the difference between the NYSE and NASDAQ, and why the aftermarket can be so volatile. Review today's vocabulary and try to spot blue-chip companies in your daily life. Thank you for listening to the Everyday English Bite, and I will catch you in the next episode.